Okay, well, let's take a look at financial statements and see exactly how these things work. Okay, what I'm going to do is I'll illustrate my slides as I'm moving along, so I'll just move them out of here. Okay, so effectively, what are we doing here? We're talking about financial statements. Now, for people who are not familiar with financial statements, these things are simply documents that record the historic activities of the company from a financial perspective. Okay? So they're historical. But they're used to help make decisions into the future. The two financial statements that are most commonly used, or ones that you will see most often, is a statement called the income statement and another statement called the balance sheet. Now, my goal here is for you to have an understanding of what these documents are and how they work. So let's move through them. They're interrelated, first and foremost. The balance sheet is a snapshot. You can imagine taking a picture of a moment in time, and that's exactly what a balance sheet does. How much is that company valued at right at an instant? And you'll notice that all balance sheets will tend to have a statement at the very top that says at a certain day or at a certain date. So at December 31st, at January 31st, it really doesn't matter what the date is. The fact of the matter is that a balance sheet is of a point in time. The income statement is a flow document. It measures revenues and expenses over a period of time. That period ends at the same time that the balance sheet is formed. So if the balance sheet, for example, is at December 31st, the income statement is up to the period ending December 31st. And that way we can get a measurement of how much money was how much revenue was brought in and how many expenses were incurred for a period of time. And that's the thing with accounting. Accounting works in cycles. We call it the accounting cycle, actually. And effectively what it does is, in order to measure how a company is doing, we pick a particular point in time, a start date, and we move ahead to another point in time, usually 1 year. It doesn't have to be. It could be multiple years, it could be months, but for the most part it is 1 year. So an accounting cycle lasts 1 year. And what it does is we will start on a given day. We'll record the revenues and the expenses for a firm right through, bringing you up until the end of the period. And at the end of the period, there will be a day of reckoning, and that day of reckoning will record a balance sheet, how much the business owns and how much the business owes on that certain date, and it will record the income over the course of that date and the expenses over the course of bringing it to that date. So with that in mind then, let's take a look at how these statements are used first before we actually look at the actual statements. As I said to you, we have something called the accounting cycle or business cycle. Now let's start on a day. Let's make this day right here, day 1. We're going to say day 1. Now on day 1, effectively, it's the day that you decide to start that business. And when you start that business, and keeping in mind the entity concept that I just talked about, you're going to start the business as separate from you. So how do we start a business? Well, one of the things that you need to do is open a bank account for the business. So let's just pretend that for the purposes of this explanation, your business has a bank account. So let's put some money in the bank account of the business. The bank. So this is the bank for the business. Let's say you put in $1,000. Okay, you put in $1,000 into that bank account in the name of the business. Now, the business is separate, so let's assume that bank account is separate from you. You want to consider that you'd like to get the money back from the business at some point in time. You know, you basically loaned it to the business in order to get started. So what we're going to record that in is an owing. So business owes you $1,000. So you have put the $1,000 in the bank in the name of the business. and the business recognizes that it owes you. So what the business owns, that $1,000 that you've given the business, and what the business owes, that $1,000 that the business owes you, is in balance, meaning that one will match the other. And this is exactly what we know as the balance sheet. All the balance sheet does is it shows at a particular point in time, okay, what the business owns and what the business owes. Okay? That's very simple, but that is the basic concept behind a balance sheet. It is a point in time that clearly demonstrates what the business owns and what the business owes. Now, the owing part here can be broken into two components. The first component is what it owes to owners. In this case, you, what it owes to owners. But it also could owe money to other outsiders, lenders, banks, people who are not in control of the business. So we're going to call those non-owners or non-owners. So we can break down what the business owes into two parts. What's owed to owners and what's owed to non-owners. Regardless, one side, the owned side, will always balance with the owing side. So this then is our very starting balance sheet for the business. Now, this is what the balance sheet will look like on this day right here, day one. Now, as your business moves along in terms of its accounting cycle, and it moves along in time, your business will earn revenues because it does things like your business could be, say, for example, a carpentry shop. You do work for people and you generate revenue. And that's money coming into the business, okay? The money comes into the business. It also incurs expenses. As the business does the things it needs to do in order to make money, it's going to incur some expenses, to buy wood or buy machinery or these sorts of things. So the business incurs expenses. And what's going to happen is that these expenses and these revenues will record it for the whole year. We're going to record them coming in. And that's what we use the income statement for. And the income statement measures a period of time. So the period of time, in this case, would be a year. So we're going to record revenues and we're going to record expenses over the course of the year. So for example, let's assume that you have revenues over the course of the year of $10,000. You do work for people and you generate revenues of $10,000. You incur expenses during the year, bought supplies and these sorts of things of, let's say, $2,000. So you come up, and again, we're at this point 1 year from now, and we're going to do a day of reckoning. This day of reckoning is known as our year end. We want to be able to tally up how much money we've made over the course of the year. So our income statement is the reckoning sheet. So it is for a period of time, so from the start of the year to the end of the year, we've had $10,000 in revenues. We've had $2,000 in expenses. If we do the math on that, we will get a profit of $8,000. In other words, essentially we have brought in $8,000 to the good. Our net income, what we say our net income, is $8,000, which is simply the revenues minus the expenses. So revenue minus the expenses equal our profit. Okay. So essentially what our financial statements do are to record these items. What we put into the business, the balance sheet, how much the business owns and how much it owes, and the measurement of income and the measurement of expenses to give us a profit. So at the end of the year then, we've done all this, we've earned this money, and now we're going to create another balance sheet for the end of the year. In this particular instance then, let's assume nothing else has changed. $1,000 was in the bank to start with. Business owed $1,000 to you. The business has made an $8,000 profit. Let's assume you don't take any money out of the business. You're going to reinvest this. Effectively, then, we're going to create a second balance sheet. The second balance sheet will be at the year end. And the balance sheet will show what the business owns and what the business owes. Now, in this case, the business had $1,000 in it to start with, and it's made a profit of $8,000. That's the net money that came into the business. So effectively, we could say that the business has $9,000. It owns $9,000 worth of stuff. That could be in form of cash, accounts receivable, any number of things that are stuff that's near cash. But let's, for our purposes, say that on this day, which is after 1 year, the business owns $9,000. So it's the $1,000 that was there to start with, plus we've added $8,000 to it. What it owes, well, in this particular instance, the business owed $1,000 to you to start with because this is the money that you put into the business, but it's also generated $8,000 in income that you didn't take out of the business, you kept in the business. So it will be the $1,000 that you started with, plus the $8,000 that you've generated, and the business will say to be owing $9,000. So your balance sheet at the end of 1 year will show this. It will have what we call assets, which is what the business owns, useful business assets that are used to make money for the business. That is $9,000. What the business owes, in this case it owes it to the owner, which is you, $9,000. Our balance sheet is in balance. And this would reflect how much the business is worth at the end of the first year. This cycle would continue into the next year, where we'd earn money over the course of the next year. We'd generate a new balance sheet next year, generate a new balance sheet, and so on. So this cycle continues and continues and continues and continues. So our business is constantly changing through the fact that it's earning revenues and incurring expenses. And at a point in time, at a day, a year end we call it, we do a measure up of the total income for that period, total expenses for that period, to find out our net profit. We also do what's called a balance sheet to assess what the business owns and what the business owes at that given point in time. So that's effectively the balance sheet and income statements explained. Okay, well that's as far as I'm going to go in this video. I hope that that was useful to you. I'd recommend that you take a look at the examples in the unit to find out more. Thanks.